To give a picture of the activity in a particular account, each transaction must be posted in the company ledger. Think of the ledger as a file drawer with pages. Each page is an account. To make analyzing transactions easier, accountants have developed a tool. It's called a T account and is nothing more than a simplified ledger page. Account entries are governed by the basic concept of debits and credits. Every account has a debit side on the left and a credit side on the right. Debits increase asset accounts and decrease liability accounts and owner's equity. On the other hand, credits decrease asset accounts and increase liability accounts and owner's equity. Consider, for example, an owner's initial investment, let's say $7,000. The accountant will enter the transaction. The first entry affects the cash account, which is an asset. The transaction increases the company's cash, so it's debited $7,000. On the right side of the equation, owner's equity is also increased, so that account is credited. With these entries, the accounting equation remains in balance.
But if every transaction's different, how do you know when to debit an account and when to credit it?
Simple if you consider the equation. Assets are on the left side.
Okay.
And left is the debit side of any account.
Does that include asset accounts?
Yes, and since assets are on the left side of the equation, they are always increased on the left, or debit side of their accounts. And if you remember that, the rest is logical.
So, on the right side of the equation, you have liabilities and owner's equity.
Would debits increase or decrease them?
Let's see. Debits increase assets, so they decrease the other side of the equation.
And to increase that side?
Well, credits. Credits would increase them.
It's only logical. For example, assume the company purchases supplies. $200 on credit. The supplies account is an asset. Supplies are increased, so debit the account. And on the other side of the equation, we have accounts payable, a liability. It increases also.
So I think you credit it. On the right side, credits increase.
And now the company purchases computer peripherals, including a laser printer and scanner, for $2,500. This increases the equipment account, an asset. And because cash is paid out, it decreases the cash account. The accountant debits the equipment account and credits the cash account. The accounting equation remains in balance, and debits $2,500 equals credits of $2,500. And of course, this company has customers. A project is completed for an important client, and the firm immediately collects $4,200. The cash account is debited $4,200. And on the right side of the equation, a credit entry to the revenue account, which increases owner's equity. Ah, the monthly rent comes due. $800. A check is written. The cash account is decreased by the amount of the check.
So credited it.
And since this is an expense, and expenses reduce owner's equity, the account is debited for $800. Notice that the increase in rent expense reduces owner's equity. The owner of the company has personal rent to pay too, along with other living expenses. So there is a withdrawal from the company account, in this case, $1,000. This is not an expense, but it does reduce owner's equity.
Well, let's see. If owner's equity is on the right side of the equation and we want to reduce it, then we have to debit the withdrawal account.
Now, the business needs computers and software. Total cost $5,000. The company pays $1,000 down and signs a note for the remainder.
A note?
A promise to pay later. In this case, $4,000.
This seems, complicated.
Not if you've paid attention, though it does require a compound entry. First, the equipment account, an asset, increases and so is debited $5,000. Cash decreases by $1,000. Credit it. And on the liability side of the equation, notes payable.
Increases $4,000. A credit.
Exactly. Ah, so it's time to make a payment on those supplies that were bought on credit. $100.
Let's see. On the liability side, debit the account. That means reduce accounts payable $100. Assets are reduced too, so credit them. That's $100 for the cash account, so the equation balances.
Finally, how about a payment of $300 on a note? How would it be recorded?
Well, that's another liability to be paid on, right?
Uh-huh.
So, reduce notes payable with a debit and cash with a credit.
We've been recording transactions directly into the ledger accounts, but in reality, transactions are first recorded in a company's journal.
You mean the same transactions we've seen would already be recorded in a journal?
That's right. For example, remember the first transaction we looked at?
The initial investment, $7,000.
That transaction would be entered into the journal as cash, an asset, so the cash account is debited. Owner's equity is also increased, so it is entered as a credit.
I think I understand, but can we see it one more time?
Let's look at the next transaction. The company purchased $200 worth of supplies on credit. So in the journal, record a debit for the supplies account. And to balance it, we would record a credit for accounts payable.
Oh, I see. After a transaction is recorded in the journal, it's then posted to its proper account in the ledger.
Yes, then you can look at a ledger and see what's been going on with an account. All those debits and credits, they're added and subtracted to come up with a final figure.
That final figure in an account is called an ending balance.
Excuse me, I have a question. Now that we have all these figures, what do we do with them?
For one thing, we can create the financial statements.
Hey, we did that last time I was here.
True enough. But we skipped an important step, the trial balance. We use the trial balance as a quality check.
So the trial balance is really a summary and a good check for me to find out, is there anything weird? Is everything being posted the way it should? The trial balance actually is an accumulation of all of the entries from the general ledger. So what's produced to begin with is a chart of accounts with the balances for each account that we have. And then you can look at the whole chart of accounts and make sure that your balance sheet balances and that everything puts down to zero, because you've got your debits and your credits on that.
So the ledger supplies the figures for the trial balance.
And with an accurate ledger, it seems pretty easy to put together.
Let me reiterate. First, the ledger accounts are listed and columns created for debits and credits. Then the figures from account balances are transferred to their proper column. Once they are all listed, each column is totaled. And the bottom line is, they must balance. Total debits have to equal total credits. Now we have the proper information to create the financial statements, which are, after all, the end product of the accounting process. They provide a summary of a company's operating performance and financial position. For example, the income statement lists all revenues and expenses for a particular period of time. Do you recall the figures recorded in the journal and then posted to the ledger? Revenue included $4,200 received for work performed, and there were expenses, including $800 for rent. The point is, those figures travel through the accounting process and wind up here on the income statement. So, we have a picture of profit or loss over a particular period of time. In either case, profit or loss, the figure goes directly to owner's equity.
Is that me?
Well, here is where one finds the owner's original investment and all the transactions recorded in the journal and posted in the ledger that have affected it over a certain period of time. Net income, for instance, and also any cash withdrawals that were made. $1,000 if I recall. Now the balance sheet. Again, the figures for the balance sheet come from journal entries and ledger postings.
I know about this. It has 3 headings: assets, liabilities, and owner's equity.
You mean like the accounting equation?
Exactly. And if you peruse this statement, you'll see that assets and liabilities accounts in the ledger are represented here.
And I remember this. The balance sheet has to balance.
finally, we have the statement of cash flows. Be aware that the figures are a reflection, in fact, practically a mirror image of the cash account in the ledger. Very valuable, for it shows the cash transactions in detail and a pattern of cash coming in and going out over a period of time, an important measure of a company's ability to pay current debts. Thus, you have the 4 financial statements, and I assume you're keenly aware that they are the result of the accounting process. Fascinating if you stop to think about it, for the process gives you a time-tested, reliable procedure for turning real-life events, transactions, into numbers that can be verified by source documents, which are analyzed using the accounting equation, originally recorded in the journal, then posted to accounts in the ledger, and checked by a trial balance. And finally, communicated to the world by financial statements. The essence of accounting is what you have here, the foundation, really, of all accounting systems.